Your parents bought a house on one salary in their 20s. In 1980, the median U.S. home cost 3.5 years of the median income. In 2024, it costs 5 years nationally, 12 years in Los Angeles, 10 in San Jose. You are not lazy. You are not financially undisciplined. You are buying into a different system than they did. And the system was built that way through hundreds of separate policy decisions, not one villain. To understand why the same shelter costs 5 times more in real terms, start with what changed and what didn't. Since 1980, U.S. home prices have risen approximately 551%. Median household income has risen approximately 373%. In inflation-adjusted terms, the median household has gained roughly 18% in real purchasing power over 44 years. Housing has gained vastly more. The result is mechanical. A larger fraction of household resources now goes to the same shelter, the numbers in human terms. The median first-time U.S. home buyer in the early 1980s was 29 years old. The median first-time home buyer in 2024 is 40, same person, 11 years later. Millennials at age 35 own homes at 52%. Boomers at the same age owned at approximately 65%. Roughly 13 percentage points of home ownership gone in a single generation. For renters, the picture is starker. Median U.S. rent in 2024, $1,950 per month. Median household income works out to about $7,000 a month. That's 28% of income on rent nationally, in line with the historical 30% rule that defined housing affordability. But 22 million U.S. renter households now spend more than 30% on housing. 12 million spend more than 50%. The down payment math is the heaviest hurdle. 20% of a $64,000 home in 1980, $13,000. 20% of a $420,000 home today, $84,000. More than 6 times the cash. Before mortgage approval, before furniture, before moving. That's the texture. Now the structural causes. On paper, the case that the U.S. housing system works as designed makes sense. 5 clean arguments line up behind it. The wealth-building argument. Home ownership remains the single most important wealth-building mechanism for the U.S. middle class. Median net worth of U.S. homeowners in 2022, approximately $396,000. Median net worth of renters, roughly $10,000. The system rewards entry even at high prices because leveraged ownership of an appreciating asset compounds for decades. The local government argument: zoning regulations were not designed to make housing unaffordable. They were designed to preserve neighborhood character, protect property values for existing owners, and give residents control over development. These are real democratic preferences expressed through local elections. The financial stability argument: institutional rental investors, Blackstone, Invitation Homes, American Homes for Rent, provide backstop demand for housing during downturns, preventing the kind of cascading foreclosures that defined the 2008 crisis. They professionalize rental management. Critics call this financialization. Defenders call it institutional capacity. The supply is coming argument. Zoning reform is accelerating. Minneapolis eliminated single-family-only zoning in 2018, Oregon in 2019, California in 2021. Washington in 2023, Vermont in 2024. The political coalition for abundant housing has grown rapidly since 2018. The supply response takes 10 to 15 years to fully cascade, but it is happening. The historical context argument: the 1980 ratio of 3.6 was not normal. It was the result of decades of post-war suburban subsidy, FHA, redlining affected federal lending policies. Today's ratio reflects a more market-priced housing system without those subsidies. The lost golden age was constructed. It wasn't a baseline, 5 arguments, none of them wrong. This episode isn't an indictment of homeowners, of cities, or of capital markets. It's a structural observation about a specific gap, the gap between the popular framing, usually about one villain like BlackRock, and the documented reality, which is that housing affordability is the compound output of 4 separate structural forces operating simultaneously. Picture 4 structural drivers, same housing market, 4 separate causes, all moving in the same direction. Driver A, the supply problem. In most major U.S. cities, the majority of residential land is zoned for single-family detached homes only. No duplexes, no triplexes, no small apartment buildings. Los Angeles, roughly 75% of residential land. San Francisco, about 65%. Seattle, about 75% before 2019 reforms. Minneapolis, about 70% before 2018, when Minneapolis became the first major U.S. city to eliminate single-family-only zoning citywide. The effect? Even when developers want to build more units to meet demand, they cannot. Density is illegal. Across most of the available land, demand rises into a fixed supply curve. Prices rise. Driver B, the rate cycle covered in episode 1.7. The Federal Reserve held its policy rate near zero for most of the period from 2009 to 2021. 30-year mortgage rates fell from about 6% in 2007 to under 3% at the 2021 bottom. Lower mortgage rates do not make houses cheaper. They make monthly payments cheaper at any given price. Buyers respond by bidding up prices until the monthly payment is back at the old equilibrium. The Fed's rate policy converted to higher purchase prices, not lower carrying costs. At 7% on a $400,000 loan, monthly payment is $2,661. At 3% on the same monthly payment, the loan supports approximately $632,000. Cut rates in half, the same monthly budget supports a 58% higher price. That's what happened. Driver C, 15 years of underbuilding. U.S. housing starts peaked in 1973 at approximately 2.4 million units per year. By 2008, they had fallen to about 550,000, a 77% collapse. Critically, housing construction did not recover to the long-run trend rate for 15 years. Between 2008 and 2023, U.S. housing construction averaged about 1.1 million units per year, far below the 1.5 to 1 7/10 million per year needed to keep up with population growth. Cumulative U.S. housing shortage estimates as of 2024, 3.8 to 5.5 million units. That's a Texas-sized hole in the supply. Driver D, the financialization of housing. Here, the brief and the popular discourse have some catching up to do. The framing that BlackRock is buying up neighborhoods is largely conspiracy theory. BlackRock does not buy single-family homes directly. The Wikipedia article on this topic is titled BlackRock House Buying Conspiracy Theory, because the misinformation became widespread enough to merit its own entry. The actual institutional single-family ownership in the U.S., approximately 600,000 homes of 88 million U.S. single-family homes. That's about 0.7%. Concentrated in Sunbelt metros like Phoenix and Atlanta, where institutional acquisition reached 2 to 5% of local stock. In 2024, institutional buyers acquired 0.3% of the $2 trillion in U.S. home sales, down 90% from the 2022 peak. That's institutional. The deeper financialization story is bigger and more diffuse. The U.S. residential real estate market is now valued at approximately $50 trillion, the largest single asset class in the world, larger than U.S. stocks, larger than U.S. bonds. Capital flows toward it from small landlords, vacation buyers, REITs, foreign capital, family offices, retirement portfolios. The real story is not that BlackRock owns your neighborhood. The real story is that housing became, from roughly 2009 onward, a leveraged inflation hedge for a much broader class of capital. And that capital competed for the same supply you wanted to live in. 4 drivers, 1 housing market. Move anyone, the price moves a little. Move all 4 at once, the price doubles in 20 years. This episode is sponsored by my own private community. If thinking about housing as 4 compounding mechanisms instead of 1 villain made you want to go deeper, this is built for it. A library of housing market breakdowns, supply economics by metro, financialization data updated quarterly, zoning reform tracking state by state, the buy versus rent math for every major U.S. market, the library nobody put in your textbook. Link is in the description below. All right, back to the diagnosis. Most people picture the housing problem as a story about a specific bad actor: greedy developers, Wall Street, boomers, foreign buyers. Sometimes those are real. Underneath them, 3 structural insights, 3 different centuries. Name what is actually happening. Mechanism 1. In 1879, American economist Henry George published a book called Progress and Poverty. It became the best-selling economics book of the 19th century after the Communist Manifesto. George's central observation: as productive economies grow, the productive gains accrue disproportionately to landowners. Land is fixed in supply. Wages stagnate while rents rise. The economic upside of growth is captured by whoever owns the land underneath the productive activity, not the workers who created the value. Where progress is fullest, poverty is deepest. George proposed a single tax on land value to break the dynamic. The proposal was politically defeated, but his diagnosis, that land speculation captures the surplus of growth, has been empirically validated across the 20th century in nearly every fast-growing metro. U.S. housing in 2025 is the canonical case. Mechanism 2. In modern empirical economics, Harvard's Edward Glaeser has spent 25 years measuring exactly how restrictive zoning suppresses housing supply and inflates prices. His finding, repeated across dozens of papers and 2 books, Triumph of the City in 2011, Survival of the City in 2021, in metros with restrictive zoning, housing prices are 30 to 50% higher than they would be under less restrictive regulation. Boston, San Francisco, Los Angeles, New York, every single one of these is significantly overpriced by Glaeser's regulatory cost model. Restrictive zoning makes cities expensive, always. The political economy is structural. Existing residents vote in local elections. Future residents, and who haven't moved in yet, have no political voice in the cities they want to move to. The system tilts toward the people who already own the land. New entrants pay the markup. Mechanism 3, in 2023, Princeton sociologist Matthew Desmond, who won the Pulitzer Prize for his 2016 book Evicted, published Poverty by America. His central framing: housing has become an asset class first and shelter second. Desmond is not blaming a single bad actor. He is identifying the structural shift between roughly 1980 and 2025. The U.S. housing system transitioned from a primarily shelter-providing institution subsidized by federal policy oriented toward family formation to a primarily wealth storage and extraction institution, financialized, market-priced, investor-oriented. The shift was not a single decision. It was hundreds of separate policy moves in tax law, zoning, monetary policy, and federal housing finance. The cumulative effect: housing now serves capital first, occupants second, 3 mechanisms, 3 different centuries. George diagnosed the land speculation engine in 1879. Glaeser measured the modern zoning damage. Desmond named the financialization that completed the transition. Once you see the mechanism, the rest of the story is what it does to one cohort at the level of one life. The median U.S. millennial, born in 1990, age 35 in 2025, home ownership at age 35, 52% versus 65% for boomers at the same age. 13 percentage points of home ownership gone, irrecoverable absent significant policy change. Median home price $420,000. Median household income $84,000. Down payment at 20%. $84,000 in cash before furniture, before moving, before the closing costs. For a boomer at age 35 in 1981, the equivalent number was $13,280, 6 times less in absolute terms. Adjusted for income, still a much smaller hurdle for renters specifically, gnawing currently 48% of millennial households. The cost burden math is worse. 22 million U.S. renter households spend more than 30% of income on housing. 12 million spend more than 50. That's the personal scale. At the level of one generation, boomers retiring in 2025, approximately 70% of homeowner. Boomers have paid off homes. They retire with a major wealth storage vehicle taxed at favorable capital gains rates, eligible for step-up basis at death. Millennials projected to retire in roughly 2055. Roughly half of those who do own homes will still have mortgages at age 65. Significantly fewer will own homes at all. Net result, median 50-year-old in 2050 will have meaningfully less net worth than the median 50-year-old in 2020, primarily because the housing wealth channel was narrower at the level of the political system. Roughly 65% of U.S. households own homes. Existing homeowners benefit from the current system, appreciating asset, mortgage interest deduction, capital gains exclusion, neighborhood zoning protection. They vote in local elections. They are the political coalition that determines zoning, permitting, and housing policy. Renters and would-be homeowners, the people most damaged by the system, are roughly 35% of households. They have less time to attend zoning meetings. They are more transient. They are systematically underrepresented in the political process that determines housing supply. The political economy is structurally tilted. The system is not broken. It is working exactly as designed. Once you see the mechanism in full, the brief's closing line lands honestly. The system is not broken. It is working exactly as designed. It was designed through hundreds of separate policy decisions over 50 years to reward existing homeowners through the mortgage interest deduction, through capital gains exclusion, through protected property values via zoning, restrict new supply through single-family only zoning, through permitting delays, through environmental review requirements, use low interest rates to support asset prices. Of course, between 2009 and 2021, the Federal Reserve's policy supported the value of housing as a class. Treat housing as a leveraged inflation hedge for all classes of capital, from small landlords to vacation buyers to REITs to foreign investors. For an individual participant, this means 3 things. There is no single villain, not BlackRock, not Airbnb, not investors generically. The system is composed of 4 separate mechanisms operating in the same direction. Naming one of them even correctly does not stop the other 3. There is no immune metro. Even cities that have reformed zoning take 10 to 20 years to see meaningful supply response. Minneapolis, Portland, parts of California, they are moving, but the price gap took decades to build, and it will take decades to unbuild. There is no exemption for any one cohort. Millennials, Gen Z, and any subsequent generation entering under current rules face the same structural compression? The first political economy fix is whether existing voters allow it. The second is monetary discipline. The third is supply mobilization. Each is a 10 to 20-year project. That doesn't mean nothing changes. Yimbuai coalitions have grown rapidly since 2018. Zoning reform is accelerating at the state level. The Fed has finally cooled extreme demand. Underbuilding is gradually being addressed. But for the median 30-year-old in 2025, the reforms will materialize on a 10 to 15-year horizon. The high prices persist now. The wealth was never just in the location. It was in who got to buy when. 3 operational rules to take from this. Rule 1. Map the cause to the response. If you are renting in a high zoning restriction metro, the structural cause is supply. Your most leveraged response: support state-level zoning reform politically or move to a metro that has already done it. If you are priced out by recent rate-driven inflation, the structural cause is monetary. Your response: wait. Rates and prices will both reset. If you are priced out by the down payment hurdle, the structural cause is the leveraged inflation hedge dynamic. Your response: build the down payment through any non-housing wealth-building channel and re-enter when the price cycle allows. Different cause, different response. Rule 2. Buy when the leverage favors you, not when the market does. The best time to buy a house is when interest rates are high and prices are starting to soften, not when rates are low and prices are rising. Episode 1.7 covered the math. Locking in a fixed-rate mortgage in a high-rate environment with the option to refinance later is structurally superior to locking in a low-rate mortgage at peak cycle prices. Most home buyers do the second. Rule 3, watch the supply numbers, not the headline price. The single most predictive indicator for future U.S. housing prices is the housing starts to household formation ratio. When it's below 1, supply growing slower than new households, prices rise. When it's above 1, supply growing faster than new households, prices stabilize or fall. The data is public. The Census Bureau and AUD publish both numbers monthly. Most home buyers never look at either. These are operational rules, not philosophical ones. They don't fix the system. They give you a way to navigate the housing market without believing the BlackRock conspiracy or any other single villain story. Your parents bought a house on one salary in their 20s. In 1980, the median U.S. home cost 3.6 years of income. In coastal metros today, 12, 8 billion people now wake up every morning inside an economic system where shelter is, structurally, an asset first and a place to live second. Henry George diagnosed the engine in 1879. Edward Glaeser measured the modern damage. Matthew Desmond named the financialization that completed the transition. The Federal Reserve compounded it for a decade. The system is not broken. It is working exactly as designed, just not for you. If you want more breakdowns like this, subscribe. There's a lot of math worth understanding. Numbers don't lie, but they don't explain themselves either.